Hello guys, welcome to the day 2 webinar P4 session. Today's topic is merger and acquisition. We will cover this topic in detail and then we will cover some questions of past papers. So as you know that the difference between merger and acquisition, obviously merger is in essence the pooling of interest by two business entities which result in a common ownership. And acquisition normally involves a relation of parent and subsidiary in which one company is parent and the company which you acquire is a subsidiary company. And in a merger, normally two companies combine together to form another company, or the operation of the subsidiary, the operation of the target company merge into the operations of the parent company. There are three types of merger: horizontal merger, vertical integration, conglomerate integration. The two companies in the same industry, if the two companies in the same industry combine together, that is horizontal merger. Obviously, the major benefits or motives of horizontal merger is the economies of scale, increase market power, and increase the range of products, improve product mix. Obviously, it is the most vulnerable type of integration, which is a threat of competition type of authorities, which can regulate your merger, which can stop your merger, because your merger can be against the public interest. What about vertical integration? Two companies in the same industry but from different stages of production chain merger. For example, in a value chain, somebody can acquire its supplier or somebody can acquire its customer. That type of integration is vertical integration. And if you acquire totally unrelated business, that is like conglomerate merger. There's a very basic knowledge of merger and acquisition type. And the next one is organic growth and inorganic growth. These are also important. Examiner can ask straightforward question from the advantages and disadvantages of organic growth. Let's have a quick discussion of the advantages of organic growth. Organic growth allows planning of strategic growth in line with stated objective. Obviously, you plan your objective, you have plenty of time, you will achieve those objectives over that time. According to the stated objective, you will move your company, you will progress your company. It is less risky because it involves time and it involves a plenty of decision-making process. The cost in organic is lower because you do not need to pay the premium in order to acquire the company, which is the feature of inorganic growth. Organic growth avoids problem of integrated new acquired companies. Obviously, you do not have to integrate the companies, so you do not have to face the integration problems. By organic growth and immediate pressure on current management to learn the new items, to learn the new techniques, it's not like that. You do not have to face any pressure, because in case of inorganic growth, in case of growth through acquisition, you have to learn the new system, the new process of the new company. So these are the advantages of organic growth. What are the disadvantages? Obviously, organic growth main disadvantage is you need plenty of time to enter into a new product or into the new market. Obviously, with the passage of time, as your business grow, obviously your competitor business will also grow, so it increases the risk of oversupply. It increases the competition. So these are the common disadvantages. What are the advantages of inorganic growth? The advantages of organic growth will also be the disadvantages of inorganic growth will also be the disadvantages of organic growth. And the advantages of organic growth will be the disadvantages of the inorganic growth. So inorganic growth means the growth through acquisition, the growth which you achieve by acquiring some smaller companies, the other companies, the target companies. Advantage, it is the quickest way to enter into a product. It is the quickest way to enter into a new product. For example, Facebook has acquired WhatsApp to quickly enter into the communication and SMS communication market. Obviously, they have their own messenger, but obviously they need plenty of time to develop that system. So they quickly enter into at a market leader stage just by acquiring another company. It reduces the risk of oversupply. As you acquire your competitors, so in markets, competition will be reduced. Acquisition result in decreased competition. That's what we have discussed. Acquisition result in increased market power. It will increase your market power. You can negotiate. You can force your price. It increase the market power. Acquisition result in the acquisition of the target company staff and highly trained staff may give you the comparative edge. These are the common advantages of organic growth and inorganic growth. Okay, let's have a quick discussion on the reasons for acquisition. Why companies acquire another company? Why acquirer acquires subsidiaries? Why acquirer acquires target companies? Which is the prime reason is synergy. That is the prime reason of synergy. What about synergy? Let's suppose you have calculated fundamental value of a stock, and that is $100. Fundamental value means the value using the estimates, like using the methods, free cash flows and or other best methods. You have calculated that this stock should have a value of $100, but in stock market, its stock market value was, let's suppose, $60. That means this company is an undervalued firm. This company is an undervalued company. So if this is an undervalued company, that can be the prime reason to acquire this company. If this company is undervalued, that will be the prime reason to acquire this company. And the reasons are synergy. You can quickly enter into the new markets and industry to acquire the target company staff and know-how. It can be managerial motive because of the arrogance of the management, hubris hypothesis. That can be because of the management personal benefits, because of the management personal pride or arrogance. Management will acquire another firm because if your firm size increases, your perks of salary size will definitely increases. Diversification or defense mechanism. If you acquire another company and if your size increases, definitely it will be difficult to acquire your company. Means of improving liquidity or improved ability to raise finance. It can increase the debt capacity because if you increase another firm, availability of non-current asset increases, or your business is reduced. So that's why ability of raising new finance increases. So these are the common reasons why you acquire target companies. So what are the different types of synergy? First, there are mainly three types. First one is revenue synergy, and second one is cost synergy. What about revenue synergy? Revenue synergy means it will increase the market power. You can sell products to more number of customers. It will increase the market synergies because you and your subsidiary will jointly will cover all the markets, and even you can sell your products into into the markets of both companies. And strategic synergy means your range of products has been increased. The services being offered from your counter has been increased, so you can sell to larger number of customers. So that's how you're gonna increase your revenue synergies. Cost synergy is basically from the economies of scale. As size of the business increases, overall cost per unit will reduces, and even as size of the business increases, you will shut down the common departments, which will result in a cost saving. And third one is financial synergy. Financial synergy, you can get the main benefit is of diversification. The other benefits can be of cash lag. One company is short of cash but have has many products, has many projects which can be profitable, and the other company which do not have any commercial project or which do not have any idea of any commercial project but has plenty of cash. So the cash of one company, the idea of another company will combine together and generate some NPV which will generate some benefits for the combined business. You can get tax benefit from the, you can get tax benefits by combining the two companies. If one company is loss making, you can combine those losses with your profit, and overall you can get the tax savings. Tax capacity can increase if two firms combines, and if overall business reduces, you can afford to take more financial risk, and if on the availability of non-current assets, you can borrow more amount from the market. These are the appropriate target for acquisition. These are very simple. Just have a look on these points after this session. Okay, now the most important part is business valuation. What about business valuation? In business valuation, the method of valuation, there are mainly three methods of business valuation. First one is cash flow based model. Second one is net asset method. Third one is market relative based model. Okay, what about in cash flow based model? First one is dividend valuation model, mainly the topic of F9, but recently examiner has tested its concept in P42. Free cash flow to the firm, free cash flow to equity, combined company value, and valuation based on APV. In case of net asset method, is a method of simple net asset value and calculated intangible value, that is CIV, calculated intangible value. Calculated intangible value calculates value according to calculates value of the intangible assets. And the last method is market relative based model, that is price to earning ratio or earning multiple or price to cash flow multiple. So these are the common methods available to get the value of equity. Starting from the first method, okay, the first method is dividend valuation model. Okay, dividend valuation model. You know the basic formula, that is equal to D naught into 1 plus G over cost of equity minus G. So what is D naught? D naught means current dividend, dividend at time 0. G means future annual growth rate. Of dividends. KE stands for required return by equity holders, that means cost of equity. And MV is equal to market share price. You can calculate growth by two methods. First one is historical dividend and second one is Gordon growth approximation. What about historical method? In historical method, remember the formula from the basic concept from F9, that was growth is equal to a latest dividend divided by earliest dividend raised to power 1 over n minus 1. That is equal to historical growth. So historical growth is equal to latest dividend divided by earliest dividend raised to power 1 over n minus 1. That is equal to growth. Okay, the second formula is of Gordon growth approximation, that is equal to G is equal to B into R. What is B? B means retention ratio, 1 minus payout ratio, that is retention ratio. B, retention ratio. R means cost of equity. Always use cost of equity. That can be calculated through CAPM. Do not use return on equity, because return on equity can be abnormally high, it can be abnormally low in any year. But overall, in the long term future, company will have to earn cost of equity as a required return. So G is equal to BR. B means you will retain some funds. R means the funds which you have retained must be reinvested at a R rate. So B means the funds which you must retain. R means the funds which you have retained should be reinvested at this R rate. So that's how G is equal to B into R. Okay, there are two methods. Okay, I think the networking problem has been resolved, and now I think there will be no issue of sound. So I'm raising it. Okay, we were discussing the single growth model that has the same formula which we have discussed in the previous slide, and that is equal to market value is equal to D naught, the current dividend which will be given. Growth will be either provided, or you can calculate through the historical or the Gordon growth model. Cost of equity will be given, or otherwise you will calculate cost of equity through CAPM. Okay, the next model is multiple growth model, and the multiple growth model is, in multiple growth model there will be you will solve question in two stages. Like first few years some abnormal growth will be given. Examiner will calculate, examiner wants to calculate like first few years with some abnormal growth, like some inconsistent growth, like with a high growth or very low growth for the first 2 to 3 years. Then after some time, like in this example, from year 4 onwards, dividend will achieve a constant growth and it will remain constant till perpetuity. For first few years, dividend will rise with some abnormal growth, dividend will rise with some inconsistent growth, like year 1 to 3. But after year 3 and from year 4 onwards, dividend will achieve a constant growth. So you will apply the constant growth formula from year 4 onwards. So first 3 years or first 4 years or even first 5 years, some abnormal level of dividend numbers will be given, like D1, D2, D3. And from year 4 onwards, you will apply a constant growth formula. So discount these cash flows with the discount factor of year 1, discount factor of year 2, discount factor of year 3. And when you apply this formula from year 4 onwards, it will be like, take the last dividend as D0, multiply it with 1 plus G. When you apply 1 plus G with the D3 dividend of year 3, it will be at the end of year 4. And divided by cost of equity minus G, when you apply this formula, this is the formula of perpetuity with growth. And whenever you apply the formula of perpetuity or annuity any year after year 1, its answer will be 1 year and earlier. So when you apply dividend growth model from year 4 onwards, from year 4 to infinity, its answer will be at the end of year 3. And to get its discounted value, you have to multiply its answer with the discount factor of last year, which means you have to multiply it with the discount factor of year 3. So simply discount first few years, like first abnormal dividends with some relevant discount factors, and when you apply this constant formula from year 4 onwards, like it will be applied like let's say it is being applied from year 4 onwards. Take the dividend value of last year, multiply it with the constant growth, divide it with the cost of equity minus G. Its answer will be at the end of year 3, and discount it with the discount factor of year 3. Then take the sum of all these values, that will be equal to market value per share. And when you multiply market value per share with the number of shares, your answer is equal to market cap or market capitalization. Okay, these are the common assumptions. It is assumed that current dividend payout ratio reflects the normal dividend capacity of business. That means the dividend which you have taken is the normal dividend level of the business. Why you are taking this assumption? Because maybe in this particular year company is paying less dividend, or in this particular year company is paying very high dividend. So if you are assuming very high dividend as a base rate, obviously your market value will be very high. And if you are assuming low dividend as a base rate, obviously your market value will be very low. So we will assume that current dividend is a normal dividend range of a business. Growth will remain constant in the future, cost of equity will remain constant in the future, and the last and most important point, dividend growth model estimates market value according to the non-controlling shareholders. Why is it so? Because non-controlling shareholder has no control over the company, and if there is a shareholder which has no control over the company, he will only focus on the dividends announced by the company. But if you have a control of the company, you did not focus over the dividends, you will focus on the complete earning or cash flows of the firm. So dividend growth model estimates market value according to the non-controlling shareholders. In order to get the control of the company, you will have to pay some extra amount as a control premium. So its answer will be low. So in order to get the proper answer, you will have to increase the answer. Obviously, you are not going to increase the answer numerically. You will just discuss in the exam. Okay, if you have any question till now, you can write in the chat box. Okay, there are a couple of questions. First one is, why in perpetuity we are dividing with cost of equity minus G? Remember one thing, this is not the formula of perpetuity. This is the formula of perpetuity with growth. This is the formula of perpetuity with growth. It's not the formula of simple perpetuity. So in case of the formula of perpetuity with growth, the formula will be dividend over into 1 plus G. It will always be discounted minus G. That is the formula of perpetuity with growth. Let's suppose if there is no growth in exam, obviously then this part and this part of the formula will vanish. Okay, another question. Should we mention these assumptions in exam? Obviously you have to mention, because there are marks in exam for these assumptions. In yesterday webinar session, there was a 17 marks discussion on the assumptions. So obviously there will be clear marks available on the assumptions. Why discounted with year 3? Okay, why discounted with the year 3? Let's have a look again with the previous slide. Whenever you apply the perpetuity formula, your answer will be at the end of last year. Let's suppose if you apply perpetuity formula from year 1 onwards, your answer will be at the end of at previous year. And when you apply this formula from year 4 onwards, definitely your answer will be at the end of year 3. And if you apply perpetuity formula from year 4 onwards, your answer will be at the end of year 3. That means you have to discount it back to the year 0 by multiplying it with the discount factor of year 3. Let's suppose an exam, if you apply perpetuity formula from year 6 onwards, let's suppose you have applied perpetuity formula in year 6 onwards. That means your answer will be at the end of year 5, because whenever perpetuity or annuity starts, its answer will be at the end of last year. So you have to multiply the answer of this figure with a discount factor of year 5. Okay, there is another question. Is it necessary to mention assumptions if not asked by examiner? Look, normally examiner always specify at an exam that you are that it is very clear in the requirement of the question that you have to mention the assumption. If question is silent and examiner has only asked about the numerical calculation, obviously you are not going to discuss these assumptions. But if there is any discussion marks are available, you must have to discuss all the assumptions there. Okay, let's move to the next slide. Okay, next topic is free cash flows to the firm. Free cash flow to firm. Free cash flow to firm means, free means available. Obviously, cash flow means cash flows free. Cash flow means the available cash flows to the investors after deducting all relevant expenses. Let's suppose if you have paid and deducted all the relevant expenses and you and some funds are still available, those funds are called free cash flow to the firms. Starting point is PBIT. The first point is PBIT. It will start from PBIT. Obviously, you will take PBIT figure from the income statement. Then apply tax on it. Let's suppose tax rate is 30%. Straightforward, apply 30% tax on the PBIT. Do not take tax value from the income statement, because income statement may include some calculation of deferred tax. So apply tax rate on the PBIT, then add back the depreciation. Why we are adding back the depreciation? Because it is a non-cash expense. But normally, then you may ask that why we have deducted the depreciation if it is equal to non-cash. Because this depreciation is equal to capital allowance. And in yesterday's session, we have discussed that whenever you deducted capital allowance in calculation of profit, your profit number will reduce, and on the reduce or lower number of profit, when you apply tax rate, your final tax rate will be lower, will be reduced. So why we have deducted depreciation in above pro forma? In order to get the lower tax. And when we get the lower profit, obviously tax will be lower, and then after applying the tax, add back the depreciation because it is a non-cash expense. Okay, then deduct the working capital change. Working capital change means current asset minus current liability of any particular year equal to working capital. Let's suppose current asset is equal to 1000, current liability is equal to 600. That means working capital is 400. And question, examiner has stated that every year working capital will increase by 10% growth. And if every year working capital increasing by 10%, that means in next year working capital will be 440 and the working capital change will be $40. Obviously, then you will deduct the capital expenditure. CapEx means capital, EX means expenditure. The capital expenditure which is used to acquire or which is used to finance the long-term or non-current assets. Okay, in PBIT, deduct the tax, add back depreciation, deduct working capital changes, deduct capex, and after deducting all these relevant expenses, if you are still available with some funds, those funds are called free cash flow to the firm. Okay, how are you going to solve it in exam? There will be two scenarios to solve an exam. First one is a single growth model. In single growth model, calculate free cash flow to the firm and it will increase with the constant growth till perpetuity. Then divided it with the WACC minus G. It is the same formula of perpetuity with growth which we have used in case of dividends. So when you apply this formula, free cash flow to the firm, free cash flow to the firm means cash flows are available to all the investors, and to all investors mean cash flows available to the debt holders. and cash flows are available to the equity holders, and if cash flows are available to all the investors, that means you will apply WACC as a suitable discount rate. Okay, how you gonna calculate market value of business? If single growth rate is given, use this formula: free cash flow to the firm into 1 plus G over WACC minus G. By applying this formula, you will calculate market value of business. And in case of multiple growth model, in question you will have to calculate free cash flows of different years, and after some few years, after some years, you will apply the perpetuity formula. Like in case of this example, you have calculated free cash flow to the firm of year 1, 2, 3, and 4, and after year 4, from year 5th onwards, you are assuming that this last year cash flow will increase with the constant growth till future, till perpetuity, with this constant growth and with this WACC. Whenever there is a perpetuity, its answer will be in the last year. Multiply it with the discount factor of last year and take the sum of all these present values. The sum of these present value will be equal to market value of business. And remember one thing: market value of business means it is the sum of market value of equity and market value of debt. But we do not need market value of debt. We only have to calculate market value of equity. So you have to deduct the market value of debt from the market value of business in order to calculate the market value of equity. Okay, what about the growth? Is it available in exam? Will it be available, or we have to calculate? Maybe in exam it will be available, or you have to calculate. If you have to calculate, you only have to calculate it using the historical cost method, historical growth method, and historical growth may be based on sales or operating profits. Like the examiner will state the growth, the free cash flows will grow with the same growth for which sales has been increasing. If sales is increasing by 10%, free cash flow will also increase by 10%. So free cash flows growth may be based on sales or operating profits. Okay, let's come to the next slide. It's free cash flow to equity. Obviously, in this slide means that all the relevant expenses, and we just have to calculate the free means available cash flows to the equity holders. Starting point is PBIT, deduct tax, add back depreciation, then deduct working capital change. Then you must have to deduct the interest expense, but you have to take its after tax value because you are deducting interest after applying the tax. So if you deduct interest 1 minus T from the above calculation, it will be like this, and then capex is equal to, and then deduct the capex. If after deducting all the relevant expenses, if you are still having some funds, that is free cash flow, and this free cash flow is only available to the equity holders. And if funds are available to the equity holders, that means you can discount it with cost of equity. Okay, how it's gonna be tested in exam? Obviously, there are two methods. First one is single growth model. And FCFE is given, growth will be given, and by using this formula, you can directly calculate the market value of equity. In multiple growth model, in first 3 to 4 years, you have to calculate different free cash flows, and after some years, examiner will ask you to apply perpetuity with growth. And whenever you apply perpetuity with growth, its answer will be in the last year, and you have to multiply the discount factor of last year with this figure to calculate present value. And by taking the sum of all these values, that will be equal to market value of equity. That's how you're going to calculate market value of equity. Okay, these are the alternative formulas to calculate market value of equity. Free cash flow to equity, and only change is we have deducted interest from the PBIT. If you directly deduct interest from the PBIT, you do not have to deduct tax from it. Then the basic difference between free cash flow to equity and free cash flow to firm is this, the interest. And if cash flow statement is given in exam, your starting point will be cash flow from operating activities. And in cash flow from operating activities, you have covered PBIT, you have add back depreciation, you have already adjusted working capital changes. So what is left here? Deduct the tax paid, deduct interest paid. If these has not been deducted in the above calculation, then deduct the capex expense. The sum of all these values will be free cash flow to equity. Okay, remember one thing, we have taken an assumption that debt paid and debt issued are assumed to be equal in calculation of market value, because it's not possible, because you are going to forecast these free cash flows to equity till perpetuity. So it's not possible. There is a scenario that every year you are paying some amount and every year you are receiving some amount. So we will take an assumption that debt paid and debt issued are assumed to be equal in calculation of market value. So when debt paid and debt received are assumed to be equal, that means it will exactly cancel out each other. So however, if there is a requirement in exam to calculate FCFE for 1 year, debt paid and debt received will also be part of calculation. Otherwise, just take an assumption that debt will remain constant, and every year, if there is a payment of debt, there will also be some same amount of debt issuance. So in case of FCFE growth can be calculated using two methods. First one is historical. In historical method, examiner can ask to calculate growth based on sales or operating profit. Examiner can state in exam that your free cash flow will grow with the same growth as the growth rate of sales or operating profit. Or there is some another method that is equal to G is equal to BR. B means retention ratio, R means cost of equity. Cost of equity is same, but what about retention ratio? Retention ratio formula is capex over free cash flow to equity before capex. But what is it? Let's suppose PBIT is 1000, tax is 30%, that is 300. Depreciation is also let's suppose 300. You have deducted interest, that is 200, and working capital changes, that is equal to 100. So the net is 700. Free cash flow to equity before capex is 700, and you have planned to invest 400 in capex. But if you have not invested in capex, you must have distributed 700 as dividends. But you have retained some amount like 400 in a shape of capex. That means out of 700, you are retaining 400 amount. Out of 700, you are retaining 700 as a retention rate. And if you reinvest this proportion of amount at R, obviously there will be a growth in dividends. Okay, these are the common assumptions of free cash flow model. First 2 or 3 are the exactly same, like which we have discussed in dividend valuation model. It is assumed that level of free cash flow will reflect the normal capacity, growth will remain constant, required return will remain constant. It is company policy to have consistent reinvestment in capex. Company will each year company will allocate exactly consistent amount in capex. Interest rate or loan amount will remain constant. It is assumed that replacement capex are equivalent to the annual depreciation. In some question, examiner state that the replacement capex is equivalent to the depreciation, and if capex is equal to the depreciation, then you do not have to add back depreciation, because if you add back depreciation, that means you have added back the depreciation. That means you have to deduct capex from those calculations. So if you do not add back the depreciation, so you do not have to deduct the capex amount. Okay, these are the main discussion of free cash flow. If you have any question from the free cash flow part, you can write in the chat box. Okay, there is a question about debt paid and received. Okay, remember one thing, whenever you are going to calculate market value in exam, always remember the debt paid and debt received are same in any year calculation. But if there is a calculation in exam, just to calculate free cash flow to equity of single year, you can separately add back the debt received, and you can separately deduct the debt payment amount. But when there is a question to calculate market value, never ever consider them the different cash flows. Always take an assumption that both of these cash flows are same. Debt paid is equal to debt received. So you do not have to do anything. tax and interest already deducted during the cash flow from operating equity, then why we are deducting again? Actually, if tax and interest has already been deducted, then you do not need to deduct these amounts again. But if tax and interest has not been deducted in cash flow from operating activities, then you have to separately deduct the tax and interest from the CFO, from the cash flow from operations. So it totally depends upon the scenario. Okay, let's move to the next slide. Asset-based approach. It's very simple. It's very simple part. Total asset minus total liabilities minus preference share value is equal to net assets. Take total assets from the balance sheet. Take total liabilities and preference share from the balance sheet. Deduct all the liabilities and preference share value from the total assets. It will be equal to net assets. If some more information is available, then try to adjust these figures. Like monetary assets, market value and book value is equivalent, so you do not have to adjust anything. These are pretty much okay. What about tangible assets? If replacement value is available, then do consider the replacement value, because if you are acquiring company on a going concern basis, replacement value is a relevant figure. And if you are disposing that company, so realizable value is a more relevant figure. And if replacement and realizable value both are not available, then use the book values. Whatever intangible values, consider only when market values are available. Do not consider intangible. Do not consider those intangibles which do not have any market or market value. Consider only those intangibles which whose market value is available. Always remember one thing: place inventory at NRV, and in case of receivable, less any allowance for doubtful debt, if any, and in case of liabilities, take its redemption value of liabilities. Problem of net asset: it does not consider future prospects. It does not consider all intangibles. It cannot be used in service-based industry because service-based industry is not a capital-intensive firm. Replacement cost is difficult to estimate. It's not easy. You have to do survey. You have to spend some amount in a shape of cost to identify the replacement cost. What are the advantages or benefits of net asset method? It can be used as a floor value or minimum value in merger acquisition, because if you try to sell your assets partially, you will get the least or floor value like the net asset value. So net asset value will be your minimum value or floor value. It is the only method used in case of liquidation, because in case of liquidation, no going concern method will be used to value the company. It can be used as a valuation method in asset intensive firm, the firm which have mainly the tangible assets. This method will be useful for that type of firm. Intangible value model, that is CIV, calculated intangible. It is equal to calculated intangible value. The first step is to identify suitable proxy company and its return on capital employed. Let's suppose you have identified that ABC company, I'm just taking an assumption, that ABC company is a suitable proxy company and its return on capital employed is 10%. Okay, that is the first step. Then take PBIT of target company. Let's suppose our company is a target company and our PBIT is 120. And then take capital employed of the target company. Let's suppose capital employed of target company is $1,000. And take industry or proxy loss and multiply it with the capital employed of target company. So let's suppose using the industry loss, using the proxy loss, your profit should be equivalent to the $100 value, but your actual profit is $120. That extra $20 is earning surplus, which is being there because of intangibles. So take its after tax value, deduct tax from it. Let's suppose tax is 30%. So take its after tax value, that is equal to 14, and then take the present value of all excess earnings at back. And when you have calculated all the present value of intangibles, then add that present value of intangibles with the book value of capital employed, that will be equal to total value. So in CIB, first step is identify the proxy company and its loss. In second step, deduct the loss of industry or proxy company, multiply it with your asset base of capital employed, and then deduct it from your profits. And obviously, if your profits are greater than the value calculated by multiplying the proxy loss with your target company capital employed, that additional amount is excess earning, and deduct tax from it. The after tax value will be after tax excess earning, take its present value, that will be equal to intangibles, and then the sum of present value of intangible plus capital employed is equal to total value. So in exam, this method can be tested for 3 to 4 marks or maximum by 5 marks. Okay, the next method is market relative base approach. In market relative base approach, calculate PE ratio. Okay, the PE ratio is market value per share over EPS. That is the formula of PE ratio. PE ratio also means earning multiple. Let's suppose market value is $200 and EPS is $10, and PE ratio or earning multiple is $20. What is the meaning of PE ratio? It means if you are currently earning $1, investors are ready to pay 20 times more compared to your earnings. And higher the PE ratio, it will show the greater confidence level of investors. The PE ratio of $20 shows for every $1 earning of your company, investors are willing to pay 20 times more. The another name of PE ratio is earning multiple. So how are you going to calculate market value? Take the earning multiple of industry or your competitor. Let's suppose your industry or your competitor earning multiple is 20 times. That means if your investor is earning $1, its value will be 20 times higher. So make it the reference, and then what about your earnings? How much you are earning? Let's suppose you are earning $5 per share. That means if your investor is earning $1, its value is 20 times more, and you are earning actually $5. That means at least your earning will be 20 times more. So the 20 times more of 5 is equal to $100. So target company is a company which is being evaluated. So take the EPS of target company, that is $5, and then multiply it with the PE ratio of proxy company, and the PE ratio of proxy company is 20 times, and the market value is equal to $100. So if take the EPS of the company for which you are calculating market value and multiply it with the earning multiple or PE ratio of proxy or industry average. These are the few adjustments which you may have to do in exam. First one is adjust earning for one-off exceptional item. Let's suppose company has deducted one-off loss, or company has added one-off income into its earning. So adjust that one-off loss or one-off income from that earnings. And if target company is a private company, you cannot take value, you cannot evaluate a private company with the help of a public listed company, because public listed company status will always be greater, because public limited company shares are marketable and liquid. So you cannot value your company comparable to the public company. If you have calculated your value according to the public company data, you must understate your answer, because your answer will be overstated. Okay, if private company has a better growth prospects, then you have to upward adjust the calculated market value. Obviously, for better analysis, always use forecasted earnings and P ratio of industry. When you use forecasted earning, it will consider the impact of future, and it will definitely be a better market value compared to the current earnings used by investors. So another method is earning yield method. That is the reciprocal of P ratio. It's very simple. Just have a just read out that slide. Obviously, you will get the concept. Okay, the next slide is price to cash flow ratio and price to book value ratio. Price to cash flow ratio means cash flow multiple, and that is equal to market value per share over free cash flow to equity per share. And if price to cash flow ratio of proxy is available, multiply it with the free cash flow of target company, you can calculate the market value of target company. Same is the case with the price to book value. So if free cash flow, let's suppose a company has some free cash flows and you are trying to calculate its value, then estimate price to cash flow ratio of proxy. Let's suppose proxy company is trading at 10 times price to cash flow ratio. Then multiply your estimated free cash flows with this 10. You have calculated the market value of target company. So that's how you're going to use price to cash flow ratios. Okay, the next method is valuation using APV method. Before starting this, if you have any question from the previous slide, you can write in the chat box. Price to cash flow ratio means market value per share over free cash flow to equity per share. That is the price to cash flow ratio means. That is the meaning of price to cash flow ratio. Okay, let's suppose if market value is $100 and let's suppose cash flow per share is $10. That means price to cash flow ratio is equal to 10. That means if your company is earning $1, if your company is generating $1 cash flow, your investors are willing to pay 10 times more than your cash flows. So price to cash flow ratio means how much investors are willing to pay compared to the $1 cash flow of that firm. And what about price to book value? Price to book value means market value per share over book value per share of that company. This ratio is mainly used in financial institutions. Obviously, this is not that much important according to the P4, but in financial institutions, normally the book value is normally equivalent to the market values, because in financial institution mainly the assets are the receivables and the market value of receivables and book values are very near. So this ratio is mainly used in financial institutions. So in that case, let's suppose the price to book value ratio is 3. That means for every $1 of book value, investors have placed your value 3 times more. Investors are willing to pay 3 times more compared to your book value. Okay, let's move to the next area. That is valuation using APV method. What is it? If your business risk is same or different with different financial risk, you can calculate this method. Divide your answer into 2 sides. One is investment side and the second is financing side. What about investment side? Calculate free cash flows of the target company and discount these free cash flows with the ungeared cost of equity. So first step is to calculate free cash flows of the target company and discount those free cash flows with the ungeared cost of equity. And we know how to calculate ungeared cost of equity from the yesterday presentation. In case of financing side, like issuance cost, calculate present value of debt shield, present value of interest saving, discount all these using risk-free rate or cost of debt, but with the before tax value. Then take the sum of investment side, present value of investment side, and present value of financing side. That will be equal to market value of business. First step, solve the investment side. Take the present value of investment side. Second step, take the present value of all the data of financing side. Then take the sum of these 2 values. It will be equal to market value of business. And when you have calculated the market value of business, how are you going to calculate market value of equity? Deduct market value of debt from the market value of business. That will be equal to market value of equity. And remember one thing, let's assume that you have calculated market value of equity that is equal to $120. Let's suppose you are going to acquire that company for $100 and your calculated market value is $120. That means you will have a benefit of $20. So if calculated market value is more or is greater than the cost of acquisition, that means the additional amount generated is a benefit, and you should or you must go for this acquisition. Okay, the last method in cash flow in business valuation is market value of a combined business. And how, when you gonna calculate market value of combined business? When there is different business risk and when there is different financial risk. If business risk is different, if financial risk is different, you will calculate market value of combined business. In calculation of market value of combined business, the first step is you have to calculate market value. You have to calculate the combined WACC. How you gonna calculate combined WACC? It includes a number of steps. First one is ungeared beta equity of both acquirer and target company and calculate beta asset. So in order to calculate the combined WACC, the very first step is to calculate beta asset of both the acquirer and the target company. So using the gearing and gearing formula, calculate beta asset of both the target and acquired company, and then calculate the weighted average beta asset using above calculated beta asset, weighting them according to their current market values. So this is the beta asset of acquirer, this is the beta asset of target company, multiply it with the weight of acquirer and multiply the second beta, the beta of acquiry, with the weight of acquiry. So what is the meaning of weight of acquirer? Weight of acquirer means the proportion of acquirer's weight in the total weight. Let's suppose weight of acquirer is 60, weight of target is 40, that means total weight is 100. So weight of acquirer proportion means 60 over total, that is equal to 60%. So beta asset of acquirer should be multiplied with the weight of acquirer in percentage plus beta asset of target company should be multiplied with the weight of acquiry in percentage, which is 40% in this part of example. So if you have calculated the weighted average beta asset, then de-gear that weighted average beta asset using the post-acquisition gearing of the group. And normally the post-acquisition gearing is equivalent to the gearing of acquirer. But obviously this information will be given in exam. When you have calculated the beta equity, put it into the CAPM equation, calculate cost of equity, then put cost of equity and KD into the WACC equation and calculate the WACC. Okay, once you have calculated the cost of equity and WACC, then calculate the combined free cash flows. Obviously, examiner will guide that how to calculate the combined free cash flow using combined WACC, discount all the combined free cash flows and calculate combined market value of business. Once you have calculated the combined market value of business, deduct total debt from it. That's how you're going to calculate market value of equity. Obviously, if let's suppose combined market value is 1200, market value of acquirer is, let's suppose, 800, market value of target is, let's suppose, 300. That means the simple addition of both market value is 1100, but after their combination, the combined market value is 1200. That means the synergy benefits should be equal to $100. And if synergy is $100, that will be the maximum premium to be offered to the target company over their calculated price. So that's how you're going to calculate market value of combined business. First step is to calculate combined WACC. After calculating the combined WACC, using that combined WACC, discount all the combined free cash flows. And when you discount combined free cash flow to the firm with the combined WACC, answer will be market value of business, deduct debt from it, your answer will be equal to market value of equity. And when you deduct market value of acquirer and target from the combined market value, it will be equal to synergy benefits. And obviously, these synergy benefits is exactly equal to the maximum premium to be offered to the target company shareholders. So these are the main steps. This is very important slide because in past paper there are many questions which have been tested by examiner from this area. So if you have any question, till now let's have a discussion on it. Then we will cover the past exam paper question. We are taking 10 minutes break, and during the 10 minutes, just try to read this question. Is a pursuit company, is a past paper exam question. This question is available in your handout section, which has been uploaded today. Welcome back. This is a past paper exam question in which examiner has asked to calculate the combined market value. Okay, let's have a reading of this question. Evaluate whether the acquisition of folder company evaluates whether the acquisition of folder company would be beneficial to Pursuit Co. and shareholder. That means Pursuit Company is acquirer and question is being asked that after the acquisition of folder, then obviously folder company will be the subsidiary, or it will be like the target company. So after the acquisition of folder company, will it be beneficial for the acquirer? Obviously, it will be beneficial if acquisition of folder company is generating synergy benefits. And if it is not generating any synergy benefits, it will not be beneficial for the acquirer company shareholders. The free cash flow to firm method should be used to estimate the value of the folder company. So the free cash flow to firm method should be used to estimate the value of the folder company. And the combined company, assuming the combined company capital structure stays the same. So we will assume that the capital structure of Pursuit Company will remain same like the existing capital structure of that company. Okay, we will solve it using free cash flow to the firm method. And obviously we will assume that Pursuit Company capital structure will remain same. Okay, what was the question? Pursuit is a listed company which manufactures electronic component and is interested in acquiring folder company and unlisted company. So folder company is a target company. The owner of the folder company are a consortium of private equity investors who have been looking for a suitable buyer for their company for some time. Pursuit Company estimates that a payment of the equity plus 25% would be sufficient to secure the purchase of folder company. That means whatever the value of equity, we have to pay 25% premium on it. Let's suppose if equity value is 1 million, that means we have to pay 1.25 million in order to acquire the folder company. Pursuit Company would also pay off any outstanding debt that folder company owed. Okay, Pursuit Company wishes to acquire folder company using a combination of debt finance and its cash reserves of 20 million. So whatever the amount needed, we will finance that amount from the debt and obviously from the available cash reserves. And the capital structure of the combined company remains same as in the Pursuit Company current capital structure. So this is the relevant information given. Market debt to equity ratio is 50-50% of the Pursuit Company. Its equity beta is given 1.18. Currently Pursuit Company has a total firm value is 180 million. So the firm value of 180 million is given. Folder Company income statement extracts are given. Obviously these are the previous years. Sales are given, operating profits are given, and the remaining cash flows. Okay, folder company has a market debt to equity ratio of 10:90 and an estimated equity beta of 1.53. It can be assumed that its tax allowable depreciation is equivalent to the amount of investment needed to maintain current level of operation. Whenever this assumption is given, like the depreciation is equivalent to the amount of investment needed to maintain current operation level, that means your replacement capex is equal to the depreciation. And whenever your replacement capex is equal to the depreciation, you do not need to add back the depreciation because capex and depreciation both are same. If you deduct the depreciation, if you add back the depreciation, you will have to deduct the same amount in a shape of capex. So there is no adjustment of depreciation, and there is an additional investment in assets of 22 cents per $1 rise in sales. So every $1 change in sales revenue will bring 22% change in capex. Okay, then it is anticipated that folder company will pay 9% interest for the next 4 years. Folder sales revenue will grow at the same average rate as the previous year. After the forecasted 4-year period, growth rate of this free cash flow will be half the initial forecast. So whatever the growth rate of the previous 4 years, after year 4, the growth rate will be exactly half. So this information is given for the combined company. For combined company, following the acquisition, it is expected that combined company sales revenue will be 51.952 billion. Combined sales revenue is given. Profit margin is given. So directly you can calculate combined PBIT. And cash flow will increase 5.8% every year. And combined interest is 6.4%. Obviously, the interest rate is 6.4%, the post acquisition gearing. Combined company will require in capex is 513. And from the next year onwards, you will have to calculate 18 cents of every $1 rise in sales. And after 4 years, its free cash flow growth rate will be half the previous year growth, that is 5.8, and half of 5.8 is 2.9. This is important. It can be assumed that the asset beta of the combined company is the weighted average of the individual company asset beta. We know that weighted in the proportion of individual company market value. Okay, the current base rate is 4.5%, market risk premium is given, and tax rate is 28%. So how are we gonna solve it? So we are going to calculate synergy, and it is equal to market value of combined business minus market value of acquirer and minus market value of folder company. Okay, that's how we're gonna calculate synergy. We need market value of combined business, then market value of Pursuit, market value of folder company. Obviously, the market value of Pursuit is given, that is $140 million. We need to calculate market value of folder company. So in order to calculate market value of folder company, we need, first of all, we need cost of capital of folder company. So that's how we're gonna calculate cost of equity. Risk rate is given, market risk premium is given, beta is also given. So cost of equity is very simple, 13.68%. And its capital structure is 90% is equity, 10% is debt. Cost of debt before tax was 9%, take its after tax value, put all data in the back formula, and back is approximately 13%. Okay, sales revenue growth is take the latest sales revenue in numerator and take the earlier sales revenue in the denominator and calculate its historical value. Take the number of jumps 1/3 and its sales revenue growth is approximately 6%. And then we have calculated operating profit margin in recent year. and we will assume that this profit margin will remain constant for next year's sales. So the sales of last year will grow every year with 6%. This 16,146 has been increased by 6%. Then all data has been rising by 6%. Then operating profit margin is equal to 32% of sales. So PBIT is the starting point. Deduct tax from it by taking 28% value. Then minus, then deduct capex from it, and capex is 22 cents of $1 rise in sales. So first step is calculate the change in sales, the difference between 17,115 and 16,146, and multiply it with 0.22. That is equal to capex 213, 226, 240, 254. Then calculate the net value free cash flow to firm is equal to these values. Discount it with 13%. Obviously, it's the multiple growth model because first 4 years cash flows are increasing by 6% growth, and after year 4, from the year 5 onwards, this cash flow 443 into 1.03, because growth rate will be exactly half compared to the previous year growth. Divided with the cost of capital minus growth. So apply this perpetuity formula from year 5 onwards and then multiply it with the discount rate of year 4. Here examiner has also shown its calculation here, and then takes the sum of all the present values, and it will be equal to 40 million. So 40 million is the value of folder company. If you have any question, let's clear till now, then we will start solving the combined value of business. Okay, I think there is no question till now. So let's start discussion of combined company. So what we have discussed in the slides, that first step in calculating the market value of combined business is to calculate combined WACC. Okay, let's have a discussion on it. What about the first step of calculating combined WACC? The first step is to calculate the beta asset of both the target and the acquired firms. So the beta asset of pursued company is, its beta equity was 1.18, its gearing was 50%. By taking its value, the asset beta of pursued company is equal to 0.686. Then putting the beta equity of folder company and ungear its beta equity using its capital structure, its beta is 1.417. And obviously then we will calculate the asset beta of combined business, that is by taking the average values according to their previous market values. So 0.686 is the beta of pursued company, multiplied it with the market value of pursued, divided it with the market value of total business. Then the beta of folder company multiply its own weight, then divided with the total weight. So the total beta is equal to, total beta asset is equal to 0.849. That is not the beta equity, that is beta asset. Regear that beta asset with the post acquisition gearing. And remember one thing in this question, post acquisition gearing is exactly the same, the gearing of pursued company. So 0.849 has been regeared by the gearing of pursued company. So equity beta is equal to 1.46. So by putting that combined beta equity into the CAPM equation, cost of equity is equal to 13.26. And by putting that 13.26 into the WACC equation, and by taking the after-tax value of KD, the average WACC is equal to 9%. Obviously, the first year sale was given, and every year sale will increase with a growth rate of 5.8%, the given growth rate. Operating profit margin is given, that is 30%. Take 30% of every year sales revenue, that will be equal to operating profit. Then deduct tax from it. Take the change, first year capex was given, then take the change of sales and then multiply that change of sale with 18 cents, that is equal to the capex of every year. By netting all these values, you have calculated the free cash flow to the firm. Discount this free cash flow to the firm with a discount rate of combined WACC, that is equal to 9%. The present value is equal to 189 million. And in last year, from year 5 onwards, you have applied the perpetuity, that is equal to 12,683 into 1.029 divided by 0.09 minus 0.029. Examiner has solved it here. Obviously, you have applied perpetuity from year 5 onwards. Your answer will be at the end of year 4. Discount rate with the discount rate of year 4. Then deduct individual market values from the combined market value. That's how you're going to calculate synergy benefits. So synergy benefits is 9 million, but the folder equity value is folder equity value is 90% of 40 million, that is 36 million, and we know from the question that we have to pay 25% premium on that 36 million, and that is equal to 9 million. That means you have to pay 9 million to the folder company shareholders, and what we have earned in a shape of synergy, that is equal to 9 million. That means we are almost distributing all the synergy benefits to the folder company shareholders, and we are not saving enough funds, enough synergy, in which we can say that shareholders' wealth has been increased of the parent company. Shareholder wealth has been increasing, but obviously with a very nominal amount. So that's how you're going to calculate the market value of combined business and individual business. So if you have any question. Okay, let's start the new topic. Method of financing merger. It's a very important topic. Method of financing merger. There are many methods to finance the merger. First one is share for share exchange, cash offer, bond offer, and the mix offer. So let's start our discussion from share for share exchange. It's a very basic example. Try to learn the concept, then we will discuss it in detail. Market value of a target company is $5 per share. Market value of acquirer is $4 per share. Acquirer has offered its 3 shares for every 2 shares of target company. Acquirer has offered its 3 shares, obviously having a market value of $4. For every 2 shares of target company having a market value of $5. Calculate percentage benefit for target company. So first one is value offered. We have offered 3 shares having a market value of $4. So in total we have offered $12 against the $10 worth of your company. So that means you are earning, you have gained $2 on the investment of $10. So that means you have earned 20% profit on it. Okay, that was a very basic example of share for share exchange. Let's move to the next example. Okay, move to this slide. Market value of target company is $2.5. Market value of acquirer is $3. And the combined market value per share is $4. What is combined market value? The market value after the combination of both companies. Obviously, look at, let's try to understand this concept. As we offered our company shares, as we offered acquired company shares against the shares of target company, as soon as you accept my offer, you and we combinedly become the owner of this company. We are offering acquired company shares against the shares of target company. I'm just assuming that you have accepted the offer. As soon as you accepted the offer, you and we become the combined owner of this company. Obviously, the combined market value will be more relevant, will be more appropriate compared to the previous market value of target, compared to the previous market value of acquired company, which was before acquisition value. So the more relevant point is the after acquisition value, because after acquisition, you and we become the combined owner of this company. So the combined market value is more relevant. So remember one thing, whenever there is a question from share for share exchange, you will always have to compare combined market value with the market value of target company. So in this scenario, the market value of target company is $2.5. Market value of acquirer is $3, and the combined market value is $4. And acquirer has offered its 2 shares. 2 shares of which? Obviously 2 shares of a combined worth. So we have offered our 2 shares having $4. We have offered $8 against the 3 shares of your company, and obviously your 1 share is $2.5 and your 3 shares are equal to 7.5. So you are currently earning $0.5 on the investment of 7.5, that is equal to 6.6% gain. And what about the gain of acquirer? Before acquisition, acquirer value was $3. After acquisition, acquirer value is $4. So you are currently earning $1 on the investment of $3, that is equal to 33.3%. So the summary is, whenever there is a question to calculate gain to the target company, compare the value offered with the value of target company. And the value offered should be based on the combined value. Value offered should be based on the combined value. Value offered then compared with the value of target company. That's how you're going to calculate gain. Obviously, in order to get the percentage gain, divide that gain with the value of target company. The gain to the acquirer is very easy. That is, simply compare the post-acquisition value with the pre-acquisition value and calculate the percentage gain. So simply we have done it. The target value was given $2.5. Previous market value of acquired was given $3. After combination of business market value, $4 is given. Compare the combined market value with the value of target company and calculate percentage gain. How acquirer will calculate gain? Simply compare the post-acquisition with the pre-acquisition value. That is 33.33%. Okay, the previous example was almost near to the past exam-based question, but obviously in exam question, one thing will be missing. That is the combined market value. You have to calculate the combined market value. Now, how are you going to calculate combined market value? There are two methods. First one is earning-based method, in which PE ratio will be given. Synergy per year will be given. Whenever there is a question, an exam in which synergy per year is given or PE ratio is given, you will use earning-based method. And if total synergy is given, you can use the second method. And if combined free cash flows and combined back is given, you can calculate the third method. So starting with the first method, that is earning-based method. How you going to identify an exam that when you use earning-based method, that is the common symptoms are synergy per year is given and PE ratio is given. So how you going to solve it? First step is calculate combined earnings. Take the earnings of acquirer, take the earnings of target company plus synergy per year. Acquired earning plus target earning plus synergy per year. That is equal to combined earnings. And then combined earnings, multiply that combined earnings with the PE ratio of group or PE ratio of parent company. When you multiply combined earnings with the PE ratio of group, you have calculated the combined market value. But this combined market value is in total amount. So divide this combined market value with the number of shares, obviously the existing shares of acquirer, plus the new shares issued by the acquirer. Do not or never consider the shares of target company, because as you acquire the shares of target company, obviously you will not going to use those shares because you have issued your own shares. So the combined market value divided with the existing number of shares of acquirer plus the new shares issued by the acquirer. That's how you're going to calculate combined market value per share. That was the first method, earning based, to calculate combined market value. What about the second method? Whenever there is a question in which total synergies are given, you simply use this formula: market value of acquirer, market value of target company plus total synergy, that will be equal to combined market value of equity. So in this case, market value of acquirer means equity value of acquirer. Market value of target means equity value of target plus total synergy, that will be equal to combined market value of equity. But we want to calculate combined market value of equity per share. divided it with the acquired existing shares plus new shares of acquirer. So the third method, that was the second method. The third method was calculate combined market value based on free cash flows. We have just discussed these steps in the pursuit company. Just have a quick recap of it. Calculate combined market value by discounting combined free cash flow to the firm with combined WACC. That will be equal to market value of business. Deduct total debt, obviously consolidated debt, total debt from market value of business. That will be equal to market value of equity, and then just divide it with the existing number of shares plus new shares issued by the acquirer. That will be equal to combined market value per share. So that was the share for share exchange. Consider one point, you always have to calculate combined market value whenever there is a question from share for share exchange. Okay, before starting the cash offer, if you have any question, let's have a discussion on those questions. Okay, in cash offer, it's very simple. In cash offer, you just have to compare the price offered with the value of target company. Let's suppose the value of target company is $5, and you have offered $6 for every share of target company. So the gain will be $1. And what about the gain to the acquired company? Simply compare the post-acquisition value with the pre-acquisition value. And if post-acquisition value is higher compared to the pre-acquisition value, so the gain will be equal to this. So what about the example? Market value of target company is $4. Acquirer is offered $5 cash for every share of target company. What about the percentage gain? We have offered $5 against your $4. There's a gain of $1, that is equal to 25%. Okay, how are we going to calculate combined market value? Where we need the combined market value? Combined market value, another name is post-acquisition value. Obviously, in order to calculate gain of acquired company, we need combined market value, or we need post-acquisition value. So calculate combined market value using any method given, like from the earning-based method, from the total synergy, or from the free cash flows. Calculate combined market value using any of the method. Then calculate combined market value shares using this formula, that is combined market value minus cash paid, because you have paid something that is like a cost to the company, divided by the existing shares of acquired. Why we are not dividing it with the new shares? Because this is a cash offer, company has not issued any new shares. Simply calculate combined market value, that is post-acquisition value. Compare post-acquisition value with the pre-acquisition value. That is equal to gain or loss to the company. So cash offer, And next is the bond offer. In bond offer, you have to calculate market value of bond. Let's suppose we are offering $110 worth bond against 20 shares of your company, and your company share price is $5. So it can be compared in per share basis or even in total basis, like $110, we have offered $110 against the 20 shares of your company, and your 20 shares has a worth of $100. You have a gain of $10. Or in per share basis, your one share value is a $5, and we have offered $110 for 20 shares. That means on per share basis, we have offered $5.5. So gain is 0.5. So the gain of acquirer is simple. Compare the post-acquisition value with the pre-acquisition value. As an example, market of target company is $4. Acquirer is offered $110 against the 20 shares. Acquirer is offered 5.5 against the $4, and the gain is 31.5%. Okay, how are you going to calculate combined market value in case of bond offer? Calculate combined market value using any of the given method, and then combined market value minus market value of bond, because you are issuing your bond free of cost, because you are issuing your bond for free, and it will be cost to the company, divided with the acquired existing shares. It will be equal to combined market value, and the name of combined market value is post-acquisition value. Simply compare post-acquisition value with the pre-acquisition value, and there will be a gain. Okay, what about mix offer? Mix offer, you are gonna combine all the any two of the previous three share offer, cash offer, or bond offer. Market value of target company is $5. Target company market value is $5. Company has offered $17 worth bond for 25 shares of target company plus 1.5 cash for every share of target company. So that means we have offered, it's not shared, it's bond. We have offered $17 worth bond against the 25 shares. That means we are valuing your shares 4.28. So we have valued your each share at $4.28, and plus we are also offering $1.5 cash. So in total we have offered $5.78 against the $5 value of your company. That means gain of your company is 0.78. Gain that you have earned in this transaction is 0.78. So the percentage gain is 15.6%. That's how you're gonna solve the mixed offer. Okay, let's have a discussion on its theory, that is method of financing merger. Method of financing merger. Cash is the most popular. For acquirer, what is the benefit of offering cash for the acquirer company? When the bidder has sufficient cash, the merger can be achieved quickly. Is a very important advantage. This process can be done in a very quick time. Second advantage, when you have a cash, in case of cash, obviously cash is a very let's say we can say it another way. Cash is a certain offer. So it will be a cheaper offer compared to the share for share exchange, because in case of share for share exchange, there is a risk that shares may lose its value, but in case of cash offer, there will not be any risk that cash can lose any value. The third advantage is acquirer can retain the control of the company. The disadvantage, obviously, you have to manage the cash, so cash flow strain or stress you will have to face this. What is the advantage to target company shareholders? Certainty about the bid value. They have a freedom to invest anywhere in a wide ranging portfolio. But the main disadvantage is they have to pay the capital gain tax. And by taking the cash, they will not become the part of the group, so they will not participate in the new group. Synergy. So what are the advantages of shares for the acquirer? The first and most important advantage is they do not have to pay anything, no cash outflow. Second advantage is bootstrapping. What is bootstrapping? That is when high PE ratio company acquires low PE ratio company, acquirer will have to pay less number of shares, so EPS will rise. So in order to increase the EPS in this way, this can be advantage for the acquired company shareholders. But obviously, the main disadvantage is dilution of control. What are the advantages for the target company shareholders? They do not have to pay capital gain tax. And obviously, by accepting the share for share offer, they will become the part of the group and they will participate in the new group synergy. But the major disadvantage is if we offer shares against the shares, obviously shares have an uncertain value because shares value may lose over the period. So that are the main advantage and disadvantage of share and cash offer. If you have any question till now, let's have a discussion and then we will solve the past paper exam question. Okay, I think you must have gone through the question. Let's have a discussion. Okay, the question was, estimate the percentage gain on Dentro company shares under each of the above three payment method. So we have to calculate the percentage gain on Dentro company share under each of the above three payment methods. 16 marks question. Okay, what about in the question? The cigarette company is a listed company producing confectionery products which it sells around the world. It wants to acquire Dentro company, an unlisted company producing high quality luxury chocolates. Cigarette company proposes to pay for the acquisition using one of the following three methods. First one is cash offer of $5 per Dentro company shares. Second offer is an offer of 3 of its shares for 2 of the Dentro company shares. Third method is an offer of a 2% coupon bond against the 16 shares of Dentro company. The bond will be redeemed in 3 years' time at a par value of $100. Coupon rate is given, redemption time is given, but unfortunately market value is not given. So this is the method number 3. So here are the extracts from the latest financial statements of both companies. Sales revenue or cigarette and Dentro company is given. Profit before tax is given. Taxation, profit after tax, dividends, non-current assets, current assets, share capital. Using this share capital, you can calculate number of shares, then reserves. Cigarette company current share price is $3.6 per share. And it has estimated that Dentro company PE ratio is 12.5%. Cigarette company PE ratio is given. And using the Cigarette company profit after tax, calculate the EPS. And by dividing the EPS with the share price, you can calculate the PE ratio of Cigarette company. Obviously, with the help of that PE ratio, you can calculate the PE ratio of Dentro company, because Dentro company PE ratio is 12.5% higher than the Cigarette company PE ratio. And the Cigarette company non-current liabilities include 6% bond redeemable in 3 years' time at a par, which is currently trading at $104 per $100 par value. Cigarette, remember the second offer, Cigarette company has offered a bond against the shares of Dentro company. This is another bond of Cigarette company that's coupon of 6%. And it's also of 3 years' time. So issuer is same, that is of Cigarette company. Time period is same, that is of 3 years. And it is trading at $104. Its market value is given. Its coupon is given. Its time period is given. Its par value is given. You can calculate YTM of this bond. The YTM of this bond will assume to be equal to the YTM of the bond which Cigarette has offered to the Dentro company. Why we are taking this assumption? Because issuer is same, the Cigarette, and the time period is same, obviously of 3 years. Okay, the last paragraph is Cigarette company estimates that it could achieve synergy savings of 30% of Dentro company estimated equity value. So the synergy saving will be the 30% of the total equity value of the Cigarette company. So that means this is the total synergy. So total synergy method will be used here. Okay, how are we gonna solve it? Moving to the answer. The answer is okay. The number of shares, first step is to calculate number of shares of Sigra company. The book value of share capital was 4.4 million. Divided it with the par value or face value. Number of shares are 11 million. And Sigra company total profit after tax was 4.95 million. And its number of shares, as we just calculated above, 11 million. So its EPS is $0.45. By just dividing that EPS with the P with the market value of $3.6, its P ratio is 8. And if its P ratio is 8, Dentro company P ratio is 12.5% higher than this. So Dentro company P ratio is equal to 9. As you have calculated the P ratio, if you just calculate the EPS by multiplying the EPS with the P ratio, you can calculate the market value of Dentro. So the Dentro company shares, number of shares are 1.25 million. This value is calculated through balance sheet, and its EPS is profit after tax divided by the number of shares. That is equal to 50 cents. And by multiplying the EPS with the PE ratio, Dentro company share price is $4.5. So cash offer is very simple. You have offered 5 and the target company is a value of 4.5. So gain is 0.5 and divide that gain with the 4.5. So the gain is equal to 11.1%. Okay, what about share for share exchange? In share for share exchange, you need to calculate combined market value. And remember, when the total synergy is given, when total synergy was given, the method was to add market value of acquirer plus market value of target plus total synergy. That's how you're going to calculate market value of equity. So same we are doing here. Market value of Sigra, 11 million into 3.6. 3.6 was the market value per share of Sigra. That is equal to 39.6 million. The equity value of Dentro, $4.5 share price, which we have calculated above, multiplying it with the number of shares, 5.625 million. And total synergy is 30% of Dentro company value. That is equal to 1.688 million. So the total equity value is 46.913 million. And the shares of Sigra is 11 million. And the new shares issued are, we have issued 3 shares for every 2 shares of Dentro company. So by solving it, these shares are equal to 12.875 million. And the expected combined market value is 3.644. And as we are offering 3 shares valuing 3.644 against the 2 shares of 4.5, so the gain is equal to 21.5%. What about the bond offer? In bond offer, everything is given except the market value. So we will assume that another bond of the same issuer has everything except YTM. So we will assume that the required return of the another bond will be same the required return of the bond which has Sigra just offered. Why the required return of both bonds will assume to be same? Because the issuer is same, time period is same, so that's why we're going to assume that both will have the same required return. So just calculate YTM. How are we going to calculate YTM? Using the IRR method terminology. Obviously, number of years are 1/3 and 3. Cash flows are every year it is equal to 6 at the end of year 100. First discount factor we assume to be used 5%. calculate present value on it, then at 4%, calculate present value on it by putting in the IRR formula. The YTM is approximately equal to 4.55%. Then discount the above bond, which have a cash flow of $2, at the end $100, discount it with discount rate of 4.55%. Calculate the market value, and market value is $93. You have offered $93 against the 16 shares. That means you have offered $5.81. You have offered $5.81 per share value against the Dentro company share, and Dentro company has a single share price is $4.5, and its total percentage gain is equal to 29.1%. So the initial comparison is made between the cash and share for share offer. Although share for share offer gives the higher return, but that is uncertain return. Cash offer is a certain return. Although cash offer return is lower, but it is a certain return. Company shareholder may prefer cash offer as the gain in the share price are dependent on the synergy gains being achieved. However, purchase for cash will mean that shareholder face an immediate tax burden. But the disadvantage of cash offer is the immediate tax burden. So company shareholder would probably prefer the cash option because the premium would only take $625,000 of the synergy benefits, whereas a share for share exchange would result in 1.2 million, almost double. So the acquirer will prefer the cash offer, but Dentro company may prefer cash offer because of its certainty, but because of its lower return and because of its tax burden, they may not be interested in cash offer. The bond offer provides an alternative which may be acceptable to both set of shareholders. Dentro company shareholder receive the highest return, of which is the 29%. And Cigra company shareholder may be pleased that a large portion of payment is deferred for the 3 years, because you are only giving the piece of paper which is called the bond. You are not giving them any cash. Obviously, after year 3, you will be paying the amount. In present value terms, a very high proportion of the projected synergy benefits are given, and you are almost distributing 1.6 million compared to $625,000 of the cash offer. So that's how you're going to calculate in exam. If you have any question, you can ask. Okay. So far we have discussed all the numerical part The discursive part of merger and acquisition. There is some another type of theory that why acquisition failed. This is very popular topic of examiner, and some defenses are given here. It's quite a theoretical reading topic. And the last part is global regulatory framework. Examiner often ask some straightforward theoretical part from these areas like mandatory bid rule, squeeze out and sell out right. Examiner often ask these type of questions in exam. Try to read these general principles. Whenever there is a question of merger and acquisition in exam, examiner will always ask almost 30 to 40% theoretical part question. So always focus on all the theory. So these are the main points which is given in this handout. Almost all the theoretical point of merger acquisition has been presented in this handout. So we have discussed almost all the areas. What are the important questions? Like you can have a practice of and just writing some important questions. This is a past paper exam question. Do not leave any of the questions. These are very important. These questions will build your concept for the final exam. I'm not exactly the spelling of this question. I'm not exactly sure about the spelling of this question, but do check it from the past paper. Okay, this question is from APV plus free cash flows. This question is from free cash flows plus P ratio based combined company. And this question is a very good part of combined WACC. It's method of financing. Especially the CIV model. And this question is from price to cash flow ratio. Price to cash flow ratio. Especially the price to free cash flow to equity ratio. So these are the questions available in past paper exam. There are many other questions, but these are the most demanding and most technical and the important question for the revision. So these questions cover almost all part of the syllabus of merger and acquisition. Okay, our tomorrow topic will be copper restructuring. And we will discuss some questions like, we will discuss the very important question, Doric company, uh, and another question that is, I think, the Patel family, and some recent past paper question. So if you have any question, please write in the chat box. Okay, there is a question that please revise the difference in concept behind geared and ungeared cost of equity. Okay, we have actually covered this topic in yesterday. We have covered this concept in yesterday topic, and especially in APB discussion. So you can listen the previous day video, and I have explained the gearing and ungearing of cost of equity through beta and even through cost of equity in detail. So try to get the video and try to listen, and obviously your concept will be very clear after listening that video. Okay, there is another question like, please solve the recent March attempt paper. If there is some question relevant, we will discuss that question. Please have a focus on merger and acquisition part, because it's a very important topic, and questions are quite challenging from this area, and especially the theoretical questions. So do have a practice on the parts. If you have any problem, do contact me. My email address is okay. This is my email address. If you face any problem, do email me. That's all from today. We will discuss copper restructuring and its question in tomorrow's webinar session. Thank you all.